Right, picture this. It's 2024, and there's a business conference in Nashville where the biggest names in tech and finance gather to discuss the future of money. In the audience sits the CEO of a small Japanese hotel company that most people have never heard of, the sort of quiet blokey you'd never notice in a crowd. 8 months later, that same hotel company has somehow accumulated over $2 billion worth of digital currency, and their stock has shot up 400%. But here's the mental part. They didn't just get lucky or follow someone else's playbook. They studied what the most successful companies were doing, found the flaws that everyone else missed, and engineered something better. While major corporations announced big digital currency strategies, only to quietly abandon them later, this Japanese hotel operator called Metaplanet has been systematically building what might be the most sophisticated corporate investment machine ever created. They've set a target that sounds completely bonkers: accumulate $20 billion worth of digital assets by 2027. That's for a company that was generating just $12 million in hotel revenue. But here's what separates them from every other company making bold announcements. They've actually built a financial system that could make it happen. Most companies trying to copy successful investment strategies get it completely wrong. They make a big purchase, announce it to the press, watch their stock jump for a few weeks, then wonder why it doesn't work long term. Metaplanet understood that corporate investment success isn't about buying assets. It's about building a machine that turns every aspect of your business into an accumulation engine. What makes this story absolutely mental is the cultural context. This is Japan, the land of conservative business practices and careful decision-making. Yet somehow, a traditional hotel operator cracked the code on modern corporate investment strategy that Silicon Valley companies with unlimited resources couldn't figure out. So I'm going to dig into exactly how Metaplanet cracked the code that everyone else missed. Because when a Japanese hotel company outsmarts some of the world's smartest investors, somebody needs to figure out what the hell they're actually doing. Right. Now, before we dive into this tale of financial engineering gone brilliant, do us a favor and hit that subscribe button, won't you? You'll want to stick around for this one. To understand how Metaplanet pulled off this transformation, you need to understand Simon Gerovich, because this isn't just a story about corporate Bitcoin strategy. It's about how one CEO's unique background made him see opportunities that everyone else missed. After studying applied mathematics at Harvard University, Gerovich built his career on analytical thinking and quantitative approaches to business problems. That mathematical foundation would prove crucial for understanding why most Bitcoin strategies fail and how to build one that actually works. His entrepreneurial journey took him through multiple industries. In 2006, he co-founded Prime Road Power Public, a solar power company, where he served as co-CEO. This experience with emerging energy technologies taught him how to evaluate revolutionary markets the traditional investors don't understand. By 2010, he founded Red Planet Hotels, a budget hotel chain that expanded across Asia. This wasn't just about hospitality. It was about building scalable business systems across different regulatory environments, skills that would prove essential when building international Bitcoin operations. But the COVID-19 pandemic forced a strategic pivot. While other hotel operators were cutting costs and hoping for recovery, Gerovich was studying global monetary policy and watching central banks print unprecedented amounts of money. His mathematical background helped him understand what most business leaders missed. Holding cash was becoming the risky strategy. Unlike most executives who looked at MicroStrategy's success and thought we should buy Bitcoin too, Gerovich approached it like the mathematician he was trained to be. He wanted to understand the underlying mechanics that made Saylor's strategy work. This analytical approach would prove to be Metaplanet's secret weapon. While other companies rushed to copy surface-level Bitcoin buying, Gerovich was reverse engineering the entire system. The moment that changed everything happened at the Bitcoin conference in Nashville in 2024, when Gerovich met Michael Saylor face-to-face. This wasn't just networking, it was a meeting of minds between two CEOs who understood that traditional corporate treasury management was failing. But while Saylor had proven the concept worked for American companies, Gerovich saw something else entirely. He realized that MicroStrategy's approach could be adapted and potentially improved for Asian markets, different regulatory environments, and companies with different operational structures. The decision to adopt Bitcoin as their primary treasury reserve asset came after months of analysis, but it wasn't just about currency hedging or inflation protection. Under Gerovich's leadership, Metaplanet had concluded that Bitcoin accumulation could become their core business model rather than just a treasury management strategy. Simon Gerovich would need to convince Japanese investors, regulators, and stakeholders that Bitcoin wasn't speculation. It was sound treasury management for the modern era. This required framing Bitcoin adoption in terms of fiscal responsibility rather than technological enthusiasm. What made Gerovich's approach particularly bold was his willingness to bet the entire company's future on a thesis that most traditional financial experts considered dangerous. This wasn't cautious experimentation. This was a CEO staking his reputation and his shareholders' money on a fundamental belief that monetary systems were changing faster than institutions could adapt. But Gerovich's commitment went beyond corporate strategy. In a demonstration of personal conviction that shocked even Bitcoin enthusiasts, he sold his own apartment in Tokyo to acquire more Bitcoin. When a CEO liquidates his personal real estate to buy cryptocurrency, you know this isn't just business strategy, it's philosophical transformation. Once Metaplanet committed to their Bitcoin strategy, they didn't mess about with cautious purchases. They announced targets that seemed completely mental for a hotel operator. 10,000 Bitcoin by the end of 2025, 21,000 Bitcoin by 2026, and a staggering 210,000 Bitcoin by 2027. At current Bitcoin prices, 210,000 Bitcoin would be worth roughly $20 billion. This is a company with trailing 12-month revenue of $12.2 million, talking about accumulating $20 billion worth of cryptocurrency. It's like a corner shop announcing plans to buy the entire high street. But here's what separated Metaplanet from other companies making ambitious Bitcoin announcements. They actually engineered a system to achieve these targets. The funding strategy was sophisticated and multi-layered, using stock acquisition rights, bond issuances, and capital raises to generate money for Bitcoin purchases. By July 2025, they were executing this strategy with military precision. July 25th, 780 Bitcoin purchased. July 11th, another 797 Bitcoin. July 4th saw a massive purchase of over 2,200 Bitcoin in a single transaction. June 27th brought another 1,000 Bitcoin to their treasury. The mathematics was staggering. They were accumulating Bitcoin at an average cost of approximately $119,000 per coin, building a position that totaled over 17,000 Bitcoin, worth over $2 billion. The company's Bitcoin yield for 2025 alone was around 450%, meaning their Bitcoin investments had gained nearly 450% in less than 8 months. But the real genius was in the operational transformation. Metaplanet's trailing revenue was only $12.2 million, yet they were holding $2 billion worth of Bitcoin. They had fundamentally transformed from a hospitality company into a cryptocurrency investment vehicle that happened to run some hotels on the side. The hotel business was now generating 877 million yen in revenue, about $6 million, while their Bitcoin holdings were worth over 300 times that amount. This wasn't just treasury diversification, this was complete business model transformation. Let me walk you through Metaplanet's financial situation, because the numbers are so mental that they challenge everything we think we know about corporate valuation and business fundamentals. Start with the market capitalization, $5.4 billion. That's larger than many established multinational corporations, with thousands of employees and decades of consistent profitability. To put this in perspective, Apple trades at about 8 times revenue. Amazon trades at roughly 3 times revenue. Even high-growth technology companies rarely exceed 20-30 times revenue for sustained periods. Metaplanet is trading at multiples that would make dot-com bubble stocks look conservative. The stock price volatility tells its own story of market madness. Shares hit a 52-week high of 1,930 yen in June 2025, then dropped to 1,206 yen by July 30th, a decline of 37.51% in just 1 month. This isn't steady appreciation from successful business transformation. It's wild swings of pure speculation. Daily trading volume averages 49 million shares, with 30-day historical volatility around 28%. These are numbers you'd expect from a meme stock or cryptocurrency, not a traditional hospitality company. The market is treating Metaplanet shares as a Bitcoin proxy rather than equity in an operating business. The enterprise value of $5.7 billion for a company generating $12 million in revenue creates a valuation multiple that defies rational analysis. If you removed Bitcoin holdings from their balance sheet, you'd be left with a hotel company worth billions, despite generating minimal revenue from core operations. The earnings per share of $0.07 on a stock price of $8 creates a price-to-earnings ratio of nearly 115. Again, numbers that would be considered expensive even for high-growth technology companies. Yet, Metaplanet isn't a technology company growing at 50% annually. They're a hotel operator that's become a Bitcoin speculation vehicle. Most remarkably, the market seems to be ignoring all traditional valuation metrics and focusing entirely on Bitcoin holdings and accumulation targets. Investors are pricing Metaplanet shares based on their Bitcoin per share ratio rather than fundamental business analysis. Metaplanet's transformation required more than just buying cryptocurrency. It demanded complete restructuring of their corporate operations, international expansion, and creation of specialized infrastructure that could support their ambitious accumulation goals. The establishment of Metaplanet Treasury Corporation in Florida marked a crucial evolution. This wasn't administrative convenience. It was recognition that serious Bitcoin accumulation requires sophisticated financial infrastructure, regulatory expertise, and access to American capital markets where institutional cryptocurrency adoption is most advanced. The decision to locate treasury operations in Florida was particularly clever. The state has become increasingly crypto-friendly, with favorable regulations and a business environment that supports digital asset operations. By establishing American operations, Metaplanet gained access to institutional investors, cryptocurrency custody services, and financial instruments that might not be available in Japan. The scale of their American expansion was massive, a $5 billion capital injection approved for their US subsidiary. This wasn't a small international office. This was a major commitment to building American operations that could rival their Japanese parent company in terms of capital deployment. Organizationally, Metaplanet restructured into two distinct business segments: hotel business and Bitcoin treasury business. This formal recognition that they were operating in completely different industries showed management's commitment to treating Bitcoin accumulation as core business rather than just treasury management. The Bitcoin treasury business segment includes not just cryptocurrency holdings, but also consulting services to help other businesses adopt Bitcoin. This represents another revenue stream and positions Metaplanet as thought leaders in corporate cryptocurrency adoption. Building international operations, regulatory compliance capabilities, and institutional relationships takes time and expertise that can't be easily copied. This infrastructure development has transformed Metaplanet from a regional hotel operator into a global cryptocurrency investment platform. Since going public with their Bitcoin treasury strategy, Metaplanet's stock has delivered around a 400% return in under a year, a number that puts most technology stocks to shame and demonstrates the market's enthusiasm for corporate cryptocurrency adoption. But this astronomical return comes with equally astronomical volatility. Daily trading volumes averaging 49 million shares indicate that the stock has become a favorite of day traders, momentum investors, and cryptocurrency enthusiasts who treat it as a Bitcoin proxy rather than traditional equity investment. The stock's movements have become almost perfectly correlated with Bitcoin price action and company Bitcoin purchase announcements. When Bitcoin rallies, Metaplanet shares surge. When the company announces new Bitcoin acquisitions, trading volume explodes and the stock price typically gaps higher. Perhaps most remarkably, the market has created a valuation premium for Metaplanet's Bitcoin holdings compared to holding Bitcoin directly. The company's market capitalization often exceeds the value of their Bitcoin holdings plus their traditional business, meaning investors are paying extra for the privilege of owning Bitcoin through a Japanese corporation rather than directly. This premium suggests that investors value Metaplanet's Bitcoin accumulation strategy, management expertise, or simply the convenience of cryptocurrency exposure through a regulated stock rather than dealing with crypto exchanges. However, it also indicates that stock price is being driven by speculation rather than fundamental analysis. The dramatic price swings create both opportunities and risks. Those who timed purchases well during market downturns have generated enormous returns, but anyone buying during peak enthusiasm has faced significant losses when sentiment shifts. However, Gerovich's approach to managing this volatility demonstrates his unique leadership philosophy. Rather than trying to smooth out dramatic price swings or apologize for the company's transformation, he's embraced the volatility as a feature rather than a bug. Metaplanet's Bitcoin transformation represents more than just corporate strategy change. It's a fundamental challenge to 400 years of Japanese business culture and corporate risk management philosophy that has shocked the country's conservative financial establishment. Traditional Japanese business culture emphasizes consensus building, risk mitigation, and harmony in decision-making processes. Companies typically spend months or years evaluating major strategic changes, building agreement among stakeholders, and ensuring that new initiatives don't disrupt existing relationships or create instability. Metaplanet's aggressive Bitcoin adoption strategy violates virtually every principle of traditional Japanese corporate behavior. They made radical treasury management changes quickly, without extensive consensus building, and embraced an asset class known for extreme volatility and regulatory uncertainty. The reaction from Japan's financial establishment has been mixed, but largely skeptical. Traditional banking institutions view Bitcoin adoption as a direct challenge to conventional financial relationships. Many established financial advisors and corporate consultants have criticized Metaplanet's strategy as reckless speculation disguised as innovation. Japanese media coverage has ranged from fascination to concern, with business publications struggling to categorize whether Metaplanet represents innovative corporate evolution or dangerous precedent that could encourage other companies to make similarly risky bets with shareholder money. The company has worked carefully to navigate complex international regulatory considerations. Their confirmation that they're unlikely to be classified as a PFIC for 2025 demonstrates the regulatory complexity that comes with corporate cryptocurrency adoption. Perhaps most significantly, Metaplanet's success is inspiring other Japanese companies to reconsider their own treasury management strategies. While few have followed their exact approach, there's growing discussion about alternative treasury assets and currency hedging strategies that would have been considered too radical just a few years ago. This cultural earthquake is still reverberating through Japanese business society, with implications that may not be fully understood for years to come. The mechanics of how Metaplanet funds their massive Bitcoin accumulation program represent sophisticated exercise in corporate financial engineering that pushes the boundaries of traditional treasury management and corporate finance theory. With around $117 million in debt outstanding specifically used to fund Bitcoin purchases, Metaplanet has essentially created a leveraged cryptocurrency investment strategy using corporate borrowing. This approach amplifies both potential returns and potential losses, creating a high-risk, high-reward dynamic that traditional corporate finance theory would consider extremely dangerous. The company's use of stock acquisition rights as a funding mechanism is particularly clever. These rights allow existing shareholders to purchase additional shares at predetermined prices, generating cash that flows directly into Bitcoin purchases. This creates a direct link between shareholder participation and the company's strategy. Bond issuances provide another funding source, allowing Metaplanet to raise capital from debt investors who are essentially lending money for Bitcoin purchases. The terms and structure of these bonds create fixed obligations that must be met regardless of Bitcoin's performance, adding another layer of financial risk to the strategy. Capital raises through equity offerings provide the most flexible funding source, but they also create dilution that reduces existing shareholders' ownership percentages. With 686.21 million shares outstanding, the company has significantly expanded their share count to fund Bitcoin purchases. The Bitcoin NAV net asset value of around $2 billion compared to unrealized P&L of over 315 million shows that their Bitcoin investments are currently profitable, but also demonstrates the mark-to-market risk inherent in their strategy. The company's average Bitcoin acquisition cost of approximately $119,000 per coin creates a clear break-even point below which their entire strategy becomes unprofitable. Any sustained Bitcoin price below this level would force them to recognize losses on their primary asset. This sophisticated financial structure allows Metaplanet to accumulate Bitcoin at a scale that would be impossible with just their operating cash flow. But it also creates multiple points of failure that could destroy shareholder value if Bitcoin prices decline or if they can't continue raising capital to service debt obligations. The fundamental question facing Metaplanet investors is whether their Bitcoin accumulation strategy represents sustainable business transformation or elaborate speculative bubble that will eventually collapse under its own contradictions and market pressures. Analyzing their target of 210,000 Bitcoin by 2027 reveals the mathematical challenges of their strategy. At current Bitcoin prices, this would require accumulating roughly $20 billion worth of cryptocurrency over the next few years. Given their current revenue of $12.2 million annually, this accumulation would require raising capital at a scale that dwarfs their traditional business operations. The sustainability question becomes more complex when considering funding sources. Metaplanet can't fund Bitcoin purchases from operating cash flow. They must continuously raise capital through debt issuances, equity offerings, and financial engineering. This creates dependency on capital markets that could become problematic if investor enthusiasm for their strategy wanes. Their hotel business represents a tiny fraction of their Bitcoin holdings value. The disconnect between traditional operations and cryptocurrency investments means that business success is almost entirely dependent on Bitcoin appreciation rather than operational improvements. What happens if Bitcoin crashes 50% or 80% from current levels? Their leveraged position with around $117 million in debt outstanding could force them to liquidate Bitcoin holdings at the worst possible times to meet debt obligations. However, the bull case for sustainability argues that Bitcoin adoption is still in early stages, and Metaplanet has positioned themselves to benefit from continued institutional adoption. Their infrastructure, expertise, and early mover advantages could provide competitive moats that justify their current strategy. The consulting services and Web3 operations provide some diversification away from pure Bitcoin speculation. If they can build profitable businesses around their cryptocurrency expertise, it reduces their dependence on Bitcoin appreciation alone. The key sustainability factor may be their ability to maintain access to capital markets. But if market sentiment shifts, or if they exhaust their funding sources, the entire strategy could unravel quickly. The verdict on sustainability probably depends on your view of Bitcoin's long-term prospects and institutional adoption trends. If Bitcoin becomes a widely accepted treasury asset, Metaplanet's early adoption could create permanent competitive advantages. If cryptocurrency enthusiasm proves to be a bubble, their leveraged position could destroy shareholder value. After digging through all the numbers, strategies, and cultural implications, I've got to render a verdict on whether Metaplanet's Bitcoin transformation represents brilliant corporate evolution or the most elaborate speculative gamble ever attempted by a public company. Let's start with what they've actually accomplished. A 400% stock return in under a year, $2 billion in Bitcoin holdings, and a transformation from obscure hotel operator to Asia's most talked about cryptocurrency company. These aren't hypothetical gains. They're real results that have created enormous wealth for shareholders who bought in early. The financial engineering behind their strategy shows sophistication that goes beyond simple speculation. Using debt, equity, and complex financial instruments to fund Bitcoin accumulation while maintaining operational businesses requires expertise and execution that most companies couldn't manage. Their cultural impact on Japanese corporate behavior may be their most lasting legacy. Breaking 400 years of financial conservatism and proving that Japanese companies can execute radical strategies successfully could influence corporate decision-making for decades. However, the risks are staggering. A company with $12.2 million in revenue holding $2 billion in volatile assets while carrying significant debt represents a level of financial risk that defies traditional corporate finance theory. The sustainability questions are legitimate. Can they continue raising capital indefinitely to fund Bitcoin purchases? What happens when debt obligations come due during a Bitcoin bear market? How long can their stock trade at multiples that ignore fundamental business metrics? But here's what I think is actually happening. Metaplanet has accidentally created a new category of corporate entity the traditional valuation methods can't properly assess. They're not a hotel company that bought Bitcoin. They're a Bitcoin investment vehicle that happens to run hotels. Evaluating them as a hospitality company misses the point entirely. If Bitcoin continues gaining institutional acceptance and price appreciation, Metaplanet's early adoption could create permanent competitive advantages that justify current valuations. They've built infrastructure and expertise that would be difficult for competitors to replicate quickly. If Bitcoin adoption stalls or cryptocurrency enthusiasm wanes, their leveraged position could destroy shareholder value faster than it was created. The same financial engineering that amplified their gains could amplify their losses. My verdict: revolutionary strategy executed with reckless financial risk management. Metaplanet has proven that corporate Bitcoin adoption can create enormous shareholder value. Their 400% stock appreciation demonstrates real market demand. They've written the playbook for corporate Bitcoin adoption in Asia, while simultaneously demonstrating why most companies shouldn't attempt similar strategies without extraordinary risk tolerance and access to capital. For investors, Metaplanet represents either the opportunity of a lifetime or the most dangerous bet you could possibly make. The same factors that created their spectacular success could just as easily create spectacular failure. What's certain is that Metaplanet has permanently changed how we think about corporate treasury management, cryptocurrency adoption, and the relationship between traditional business operations and digital asset investment. Whether that change represents progress or dangerous precedent remains to be seen. The hotel company that became Japan's Bitcoin empire has proven that in the modern economy, the most conservative choice might actually be the most radical choice. Right, that's quite enough financial madness for one episode. If you've enjoyed this tale of corporate transformation that makes Palantir look conservative, make sure you hit that subscribe button. I've got plenty more stories about companies that have made decisions so clever they'll make you question everything you thought you knew about business strategy.